Wall Street bracing for the release of Friday's July jobs report. Analysts expect the economy to create 212,000 jobs.
We're likely going to see decent job growth in line with the 6-month average.
But there's a worrisome sign that may not happen. The ADP report, which tracks payrolls in the private sector, showed the economy only created 185,000 jobs in July, short of the 215,000 analysts expected. Now, historically, the ADP number tends to foreshadow Friday's jobs report. Analysts say job creation below 200,000 in July could throw a wrench into the Federal Reserve's plans to hike short-term interest rates at their September meeting.
Or if it's softer than that, then you're looking, November, probably the more likely one, December for that first rate hike from the Federal Reserve.
On the flip side, better than expected numbers would put a September rate hike in the spotlight, though many on Wall Street already see it as a given.
That's what this market acts like. It acts as if we're about to have a rate hike.
But it's not just employment the Fed will be watching. Wages are another critical factor. Average hourly earnings are expected to rise just 0.2% in July after showing no growth in June.
In particular for this report, I think if we see an improvement in wages, if we see at least a stabilization in the unemployment rate, perhaps even a decline there, and decent hiring. It doesn't need to be the trend that we saw over the past year. It can be low 200s. That's really all the Fed needs to see to be convinced that we're gradually reducing slack in the labor market.
Regardless of how many jobs are created in July, the Fed will likely tread carefully when it implements its first rate hike in 7 years. For The Street, I'm Scott Gamm.